Over the last couple of live streams, we've been talking about how important the Mag 7 earnings were and how important it was for them to continue to follow through if this bull market was going to continue. Now, let's get Nick on because he's been bullish these Mag 7s and particularly Amazon. He's going to explain his thesis and how he's putting on this trade. Let's get him on. Nick, great to have you back, buddy. I love these episodes we do every couple of weeks to talk about my favorite topic, which is options trading, which is just the best way of always being able to construct a great payoff trade. And there's no better person to shoot the shit about this than you. So listen, me and you have a little bit different views about how things are going to play out in the next little while. Yeah. I obviously have a little bit of concerns in the interim in terms of how much the market can go. You, and we'll let you talk about it, have a little bit more of a bullish view. Now, the one thing, though, that we both agree on is the fact that the breadth of the market is so narrow that if the bull market was to resume in the next little bit, it does really require Mag 7 leadership. Yep. It needs the stocks that have been leading this market to continue to lead. And so under the scenario, I have to always assign a probability that if you are right, then we are going to talk about it. So that's a part of your thesis. I want to hear it. What are your views here on the markets? And then we'll get into talking some trades and the individual stocks in terms of what they're going to do.
So overall, I'm pretty bullish into the January to March timeframe. Primarily because the Fed is cutting rates and they're ending quantitative tapering as well. That's very conducive to more liquidity flowing into the markets, and asset prices will inflate as inflation increases, essentially, right? So inflation floats all boats, essentially, and the stock market is one of those assets, essentially. Now, obviously, there are potential mines in the so-called field ahead of us. But that being said, I think we're going to probably skirt those mines and see some upside before we see downside into middle of next year. So I'll explain my thesis overall and the path that I'm looking at, and then I'll explain why and how I'm playing it, essentially. So looking out into the next year time frame, I think we're going to see a run until January to March-ish, then it followed by a pullback of like 5, 7, 10%, followed by a summer, kind of just a steady chop, and then late next year, I think we're going to see a heavy sell-off as we approach the midterm elections, because all signs are pointing towards the Dems taking the House and Senate, from what I've been looking at. So that will cause a lot of uncertainty in the markets, causing perhaps a decent sell-off late next year. But that being said, again, this is all my opinion. I'm not mincing words here. I could be wrong for sure, and this is why I'm always hedging myself. But looking forward, I like Amazon and Google a lot, because if we are going to push those new all-time highs above 7K on SPX toward like 7,500, for example, we need to see leadership from the Mag 7. As we've seen in this rally the past few weeks, breadth is very weak, right? You're not seeing these small companies like PayPal, for example, or small-ish companies like 60 billion market cap leading by example and pushing higher. You're seeing the names like Amazon and Google pushing up 10%, Nvidia pushing up 10%. That's carrying the market higher overall. And what I like about both those names is that they had great reports all around. They're growing their cloud base as well. AWS for Amazon and Google Cloud for Google. And basically, this AI bubble, whether it pops or not, I think it will pop at some point. I don't know when it'll happen, but I think it'll keep on getting a bit bigger before that actually happens. And so
okay. So I want to just give a little bit of support to that thing. So first of all, here's the Mag 7 index. The S&P has been up over 40% off of the Liberation Day lows. And just to kind of reflect on this, you saw basically a 77% rise in the Mag 7 stocks. They literally carried the weight of that rally higher. We're in a situation today where right now 38% of stocks are actually above their moving averages. The majority of stocks are in a correction mode, and these Mag 7s have been doing all of that work. Now, just to your point, we had earnings, right? And there were some earnings that were a little bit disappointing. Like, for instance, Microsoft attempted to break to a new high, but then earnings took the wind out of its sails, brought it right back down. Meta had a very disappointing breakdown. But the two that were actually very bullish was exactly like you were saying. You had a gap higher in Google, overall it's holding a bull flagging formation that could be a continuation pattern on the upside. And Amazon, which spent 2-3 months trading sideways throughout the summer after a bull run off of that Liberation Day low, and this bull gap to the upside on its earnings broke to 52-week highs out of a 3-month consolidation. So there's room for a measured move to 270, 280, 290. So this, I would argue, at least from what I was doing, that Amazon actually had the most room to go and is now actually structurally most bullishly set up. So the thing that you're focused on here is that these smaller number of Mag 7s need to be the generals, the leaders on this thing, and you're trading it to the upside. So you've had a couple of trades on both of these. Why don't you talk about how you've been trading it? And obviously, we're then going to need to have a conversation about, well, how do you trade it moving forward if you haven't been in? So let's start off with how you're positioned in these and what you've been doing.
Yeah, so with Amazon, I traded a simple calendar call spread. I sold, this is back when it was around 215, 220-ish. I sold the 250 strike call option for November OPEX, and I purchased the January OPEX same strike call option. The net debit there was like 320 roughly. And it's currently trading for about $8.20 or so, because you got the, even though you pushed toward that strike price for the November OPEX, what happened was that the IV contracted. So the contracts both went up in value, but the Januaries went up a lot more because they have more room to run over the course of the next roughly 80 days, whereas the November OPEX expires in 2 weeks and change, and they're currently sitting like at the money essentially, right? So the idea there has worked out very, very well, and it's purely based on asymmetry of risk. Like my thought process going in was, okay, if we go down at all, I might, break even or come out, maybe in the red a little bit, because what will happen is that the November OPEX contract will be worth zero pretty much. Meanwhile, I still have 2.5 months left on my January contracts, right?
Right.
And so my thought process here now is, if we expire above 250 come November OPEX in 2 weeks and change, I can turn this into a butterfly call spread for a net credit overall, meaning I have zero risk to make upside of, in this case, would be the 250 long call, which I already have, short 2 times the 270 call, and then long 1 of the 290 calls for January OPEX. And
so basically, just so we can look at the technicals here, you're going 290 on the wing, one wing. You have the body of the butterfly at 270. And then you have that 250 out to January that you are currently owning, and you're just going to talking about converting that in there. All right. So your big payoff here is between now and January. If Amazon continues towards 270, is your little sweet spot zone that you've constructed here, correct?
Yeah, I mean, the idea is that you want to keep on de-risking your position overall, right? Like, do I want to be holding a call option that's currently trading at $15 per position on one asset for one expiration date? No, because if we get that, some kind of correction, like a 5% correction, for example, Amazon goes to 240, 235, and the position goes from 15 down to like $8, for example, right? So the idea here is that I want to maintain upside, but I want to do so in a responsible manner, even at the expense of not being able to monetize it early on. Because right now I can sell 2 of the middle strike 270s and buy 1 of the 290s for a net credit of $11 right now. Even if I were to buy back the short leg right now of the 250 for 2 weeks out, which is about 680 roughly, I'm still netting out a net credit overall of about $5. And I spent 320 on my initial position roughly. So that gives me a guaranteed profit of 180 no matter what, with further upside of 20 points no matter what. And then what I can do is I can play with it as Amazon moves. For example, if it pulls back, I can buy back the middle strikes and sell them again later on when it pops back up again. If it pushes heavy to the upside, like 290, for example, overnight, I'll close out the 250 to 270 debit portion of the spread, keep the credit side. When it pulls back down again, I can then buy that back opportunistically, right? It's like, it's all about kind of playing chess overall with this position.
Absolutely. So Nick, you're clearly demonstrating like the tactical element of being an active trader and being opportunistic on different little moves within the stock that you're lightening up and adding and timing this a little bit. I want to though now speak. There's a number of our listeners out there that are not in these Mag 7s, and they may resonate your story with them that these things can continue higher here over the next couple of months. If you were brand new to Amazon and you don't have a position on, what is the asymmetric way in your mind to put some skin in the game here now that this has already started to move? What's your thought?
Well, the first thing I do is determine, like, I always ask the question, like, what is your desired risk, your desired reward, your overall thesis? Are you bullish? Are you bearish? And then what's your time horizon, right? So if I'm looking out to January, which I think would be a realistic time horizon, like going out 2 weeks to November OPEX doesn't make much sense. It's too short notice. You could, maybe you win, maybe you lose, right? December, again, same thing. Like, it's still very short term. January, I'm confident because you have time to monetize positions, to adjust if need be. Your loss won't be an absolute loss if you're incorrect, right? So you do have time here. You have 72 days roughly on the position overall. So the smart way to do it would say, okay, do I want to allocate a lot of money to a given trade like Amazon? Also, what is the current implied move for January, right? Right now it's about 30 points up or down. So we could go to 280. A 1 standard deviation move would be to 280. Downside would be 220 again, right? But the way I analyze is what has happened historically with Amazon. When it's broken out to new all-time highs, it generally runs about 20% above the previous all-time high. Now, what was our previous AF? It was 240. So putting us 20% above that would be, 48 points above the previous all-time high, taking us to about roughly, 280, 288-ish, 290-ish roughly on Amazon. Again, so I may perhaps, be going too tight on my butterfly. But again, I'm doing this because I already have a position on. I want to keep upside. And as we pass the body of the butterfly as well, keep that in mind, I can monetize too, right? Like, it's not like I'm worried about Amazon shooting up $20 overnight. That could happen, sure. But we already saw with OpenAI and Amazon creating a partnership on Monday. They went up like $8-10 in one shot. They came right back down again. Earnings, they had a very good report. They went up like $30 roughly overall. Came right down a little bit, and they're settling around 250. So usually yeah.
Are you suggesting that a butterfly strategy is a good approach here for any of our listeners? Is that what you're recommending here?
Butterfly is a risky, the less risky approach, albeit the drawback is that you can't really monetize it excessively early on, right? But that being said, if you're patient with it and you just let it ride until late December, perhaps like early January, that's when you're going to see a lot of the middle strike decay, assuming we're not trading around that area, and basically you're left with a very cheap long call option position, right? If we do push toward that middle strike, at that point in time, like I said, you can be tactical and say, you know what, my current debit portion is now worth 80% of maximum profit. I'm going to close it out and then keep my credit side open. And if it pulls back again, I'll then buy back the credit side and monetize both sides, pretty much capturing a larger profit by legging out of the trade, right?
So are you then saying right now, one of the things that could be considered would be to do a 250, 270, 290 January butterfly? Is that what the strategy we're talking about here?
Yeah, you could do it right now. I mean, it's not as cheap as what I have it for because I'm obviously already in the trade, but the position right now would cost you pretty much 15 long minus 7 times 2, which is 14. So
14, it's like $4.
One and one, yeah. So, but yeah, you're risking about $4 to make $16 upside, right? Not a crazy trade overall. I mean, there is 400% upside, sure, but realistically, you're probably going to make maybe between 100% and 200% if you're closing it prematurely as we move toward the middle of the butterfly's body, essentially, right?
And then, okay, well, 100 or 200% is fine in that context. But the question, then, what I would ask you is, where would be the stop out for you? Like, would we, let's say, is the risk to it like a $2 drawdown? Are you knocking out on the butterfly if the $4 debit becomes a $2? Like, where's the risk, or would you consider the risk to being that the butterfly zeros? Like, what's your thinking on this?
So there's two like mindsets to have. Like, one of them is my former mindset, which was size larger and use a stop loss. And I noticed through my trading journal by tracking my trades that oftentimes I would stop out of a trade, even if it was like a midterm trade, 1 to 3 months out. I would stop out for my loss, and then it would become profitable, within the next like 30 days roughly. So I said, you know what, if I size down with no stop loss and said, let's say, for example, you want to risk like $4,000 net, right? You could buy 10 contracts of this butterfly position and say, you know what, I'm going to risk all of it. And essentially, like, I'm fine with that risk overall, right? I'm risking 4K to make 16K over the next 2.5 months. Or you might say, you know what, I'm going to buy, instead of buying 10 contracts, buy 20 contracts, but stop out at $2, right? Like it's the same difference. You're pretty much mitigating your loss to only $4,000, but you're just articulating it differently in the sense that you're letting one position ride to possible fruition, which might be a better move, because one of the worst things is when you have a great thesis and a good setup, and then you pretty much stop out for a loss, and then it runs in your favor. It's not a good feeling overall, right? So you're better off sizing smaller, in my opinion, sizing smaller, and then saying, you know what, whatever happens to the position happens. Because overall, like what I've learned in trading is that the goal is not to maximize your profits, it's to minimize your emotional attachment to each individual position, such that you can ride it to maximum profit or a large profit or maximum loss.
Well, the one way to also keep it simple in my mind would be for a similar $4 debit, you can just put on the straight bull call spread for a 270 to 290, right? And you put that $4 out. All you're looking for is this thing to hammer in the money, where this $4 it has the same type of $16 payoff on a $4 outlay, and it has also the potential of a clean double if in a short window of time if it went up. So I mean, there are advantages and disadvantages to more legs within the structure, but both of them are just basically it's a call on the upside of Amazon. And what we're really seeking to do is find a low risk, low capital outlay that gives you the potential to make more capital than you're putting out risk, so that asymmetry is in your favor while you're picking a stock that is trending well and has room to follow through. Is that a good way of summing it up?
Yeah, it is. Yeah, like everything comes down to asymmetry of risk, because again, kind of like in blackjack, using like Ed Thorpe's metaphor for beating blackjack, right? You're trading probabilities, understanding that each trade individually should have no more than a certain allocation of your risk profile overall, right? So you might say, for example, my maximum risk on any trade is like 5%. My minimum risk is like 1% or 0.5%. And based upon your conviction level, you toggle your overall risk threshold essentially. And then when you need to have rules of risk management, obviously, and say, you know what, like one of my rules, for example, is whenever I double my position value, I cut half. So for example, if my position went from 4 to 8 on Amazon, what would I do? I would sell half. Then I have zero risk overall net, but I still have upside. And at that point, I have zero emotion attached to the trade. I don't really care what happens. And when you have no emotion, for whatever reason in life, when you're not really like emotional about a certain subject, it tends to work out in your favor, right? So
absolutely.
It's a better way of both living and trading as well, right? Because ultimately you want to enjoy your life and be stress-free and have good sleeps and like relax and not be,
absolutely.
You know what I mean, right? So.
Listen, Nick, great ideas. Listen, if this bull market is going to continue, then I view the same thing, that the leadership is going to have to continue coming from these Mag 7s. So you might as well nail the one with has some relative strength and room to go. So the idea on Amazon, if it's going to work, it's a very reasonable way to play it. So listen, Nick, if anyone wants to follow your stuff, how can they find you, bud?
So I have my website, optionsfinity.com. It's linked below. I also have a trading service as well now, which I just started in the last 10 months roughly. We're doing pretty well. You can link it below as well. It's called Collective 2. You can see all my past trades, what I've done, my risk management, all my metrics, everything's right there. It's fully transparent. They're actual trades. And then aside from that, just I guess like my YouTube, Nick Galarnik, but I don't post very often. So it's usually here pretty much. You can find me if you want to find me, essentially.
There you go. Yeah. All right. Well, Nick, thanks for joining us, buddy.
Thanks, guys. Take care.